Well, we've got the S&P up 7 days in a row. The Nasdaq's on a flyer. We are climbing the wall of worry. The pain trade is clearly up. People are covering shorts and getting long in this situation. We think there's probably a little bit more to go in this situation as tech refines its mojo. We've seen blowout earnings from Microsoft. Meta have come to the party as well. And the baton gets passed to Apple and Amazon. Markets expecting some big moves coming through there. We are seeing a more stable US dollar. We've got the dollar index trading a range of 100 to 98. We've seen euro dollar looking to test the bottom end of that range. We're seeing gold sellers playing through, and we're also seeing Bitcoin trading a tight range as well, and we look for where the possibility of a breakout comes through. There's a lot going on financial markets. We need to be open-minded as always, and we discuss that all in today's trade-off. Well, hi, I'm Chris Weston, Head of Research at Pepperstone, and I'll be joined in 2 seconds by Blake Morrow from Forex Analytics. And as always, we'll be discussing the inner sanctums of workings of markets. We're looking at the setups, the movers and shakers, and looking at the flows that we need to be aware of at the moment, where the balance of probability lies in this situation. Blake, Mr. Morrow, would you come into the programme, my good sir? Right, what we're doing, well, there's a lot for us to talk about as always, but I think we're in a bit of a transition at the moment. People are looking at the data, but they're expecting the hard data to crack probably in the next series, probably coming through in the May series, which probably is not going to come through till June. And at the moment, the market seems to be sort of being dealt with a lot of good news in terms of tariffs. They seem to be coming to the party. We're going to see a number of deals coming through. The data, you can see soft data is weak, but some of the harder data still seems to be holding up quite well. And I think we've seen a bit of position. So I think this market, for me, we just need to be very, very open-minded to the possibilities of where it could go.
I don't disagree with you, Chris. Climbing the wall of worry is a real thing. And, markets have a lot to be worried about. But at the same time, as you pointed out, the pain trade seems to be higher at this stage, and shorts just continue to have to cover. The markets are grinding. What are we really looking? I mean, the thing that would, I think, upend this market at this point in time is that trade talks where there's no progress. If we become a point where everything's so stale and the news cycle's stale, we're not getting any recent updates, that could be maybe something that turns the market, or maybe it's the data this week that we're going to be talking about here for the rest of this program.
Exactly. I think the data's key, and I think that's the big. I mean, forget deals and agreements, two very, very different things. To form a free trade agreement, it takes months, if not years, to do that situation. A deal, do we trust the deal? They could walk away. I see it very much as a ceasefire more than anything. People don't trust it. It's there, and it mitigates the worst situation, but it can. I don't think either side are going to trust that situation. Anyway, let's go into Topical Thunder and discuss these factors in a bit more depth. Right, key levels, because look, I think an open mind is really essential here. You've seen the S&P moving up. We can talk about markets in a second. But, the Goldman Sachs most short interest basket is up 23% from its recent low. So there's been a big short capitulation. People have seen that the risk reward of holding shorts is obviously poor. The tone on tariffs have been obviously even much more positive, and we've been able to price the risk. So for me, I'm looking at the S&P, I think 5,800, I think would be a level that I'd be looking into to look to resell, and we can talk about the setups there. You've got the euro, which has had the heat's come out. We've got the bottom end of the range coming in around 113.09. I think if we get a break of that, could be interesting. I know you've got some charts around that. Dollar index 100 to 98. We've got a trading range. Bitcoin, we had a really nice move up. Big breakout, and now we're just consolidating in a range of 95,200 down to 92, just below 93,000. So that needs to break out of either situation there. Gold, we've had a bit of heat coming out there. Market's taken a bit of positioning out. So I'm sort of looking at 32.60 as the recent low is a big one there. We see buyers stepping in, or will that take another leg down as some of that positioning comes out? And also the 10-year Treasury bonds continue to find buyers here. We're trading at 4.16 on the 10-year. Can we push a little bit lower down into 4%? And that's a big kill. So some big levels we're watching. And again, we just need to be open-minded to the breaks. What are you looking at?
Well, you named off pretty much all the levels. I think one of the ones as far as the euro goes, it's I'm actually looking at 112.70 to 113, but I'm going to be talking about that chart a little bit later. The other level that I'm focused on right now is the 5650 level in the S&P. That is the 618 retracement. I know you're looking for 5800. It's interesting as you start targeting levels, a lot of times, especially if you're talking about a big index or maybe the dollar or maybe, something that gold, a lot of times you get really close, but, you start finding layers of sellers from one point all the way up to maybe your target, and you never quite reach the target because there's so many sellers lined up at these levels.
Yeah.
So I think that 5650 level is going to be very interesting just because it's a key 618 Fibonacci level in the S&P. Another big level, which we're going to talk about a little bit later, is crude. Crude's nearing $55, and the $55 level is, kind of dangerous when you're talking crude, because I don't think a lot of people believe that level can be broken.
That's a really interesting. I mean, you bring up a great point, and that crude move. I mean, Trump's going to be loving that. Absolutely, it's part of his manifesto, isn't it, to bring down crude price, bring down energy inflation. So I think I'm glad you brought that one up. Yeah,
and then you have these really tight, and I'm going to say tough to trade ranges, like the Aussie. I mean, 63.25 to 64.50, and I know you guys have an Australian election upcoming this weekend. I don't know if it's going to have any impact on the Aussie dollar, but man, that thing's stuck in a range, and it's a tight range. I think it's going to break out. It's probably going to end up being on Friday when it does break out. But, following the jobs report, I'm thinking. But, man, that one's been really tough. I haven't traded much of the Aussie because I know this range is so tight, and I know we're wound up and ready to go. So
yeah, exactly.
I
don't think the election is going to be I think the seats matter in the Aussie election. If the polls are right or the betting markets are right, and the Labour Party are going to take it. For me, you might get a bit of relief in equities if the ALP party do get a majority, just because it's the status quo and we know what we're getting. I think if we get 73 seats or above, fine. A bit of a, we'll get a government together. But I think below 68 seats, and it becomes very, very messy indeed. They have to reach out to independents below that level, and then you have to reach out to the Greens, and that becomes just a highly dysfunctional government. Nothing's going to get passed. Massive spending concessions if that do. And so that's I think that would be a bit of a messy affair, and you might see a little bit of downside in the ASX 200 banks and bits and pieces. But I don't think it's going to be an Aussie affair.
All right. Well, that's I'm glad you told us that, especially those of us that are not so familiar with the process and what's happening on the other side of the world politically, because it's like I have enough to focus on my side of the world.
It's not really a market story, to be honest. The policies are not particularly contentious. They're very aligned in most capacities. So there's a little bit of nuances at single stocks, but it's certainly not something that's going to move the Aussie dollar. It shouldn't do anyway.
Well, something, Chris, that you talked about when we first came on in our introduction, I want to shift gears over to the markets and talk about the realness of the wall of worry that we're dealing with. And as you called the pain trade seems to be higher right now. And I want to talk a little bit about this because I get so many questions about the markets, the direction of especially the S&P. Everybody's really focused on that. And I think you brought up a really good point as far as being open to options. Like, for example, there was a really good intraday setup today with the S&P. It sold off. It came back. It rallied right back to resistance. And then, at the end of the day, it started to squeeze past resistance. And then, here we are with earnings, some blowout earnings from Microsoft and Meta. And then tomorrow we have a couple other big companies. You might have heard of them. Apple and Amazon are also reporting earnings. And who knows, the thing about the markets and what they're doing is they're really brushing off any bad news and taking it all with a grain of salt. A lot of these companies are reporting earnings. Earnings haven't been horrible. I think most people are expecting next quarter to be more reflective of the environment we're in right now. But, a lot of companies are saying, hey, we're not even going to give you guidance right now. So, and people are like, oh, that's bearish, but is it? I mean, look at how stocks are responding. How the market responds is completely different. So tell, traders how you feel as far as the markets as a whole and risk as a whole?
I think the earnings season is interesting. To answer your question, I think, people are still very, very short term, up and down. There's no real. I think people aren't reading the market very, very clearly now because, I think the sentiment has shifted. I think, the S&P has moved up, but up until yesterday or the session we've just had, the moves on the up, the volumes have been very light compared to on the way down. That's typically the way when people are liquidating stocks. But, if you look at futures volumes, cash volumes, on the way up, this move that we've had, since the 9th of April, the volumes have been low on the way up and, shorts have moved up. So it's one that I think people have not trusted at all. There's been no conviction. It's bear market rally, if you want to call it that. But now I think I think people are reassessing that view at this point and saying, well, can we squeeze a little bit higher? The earnings season's been okay. I mean, the number of beats have been in line with sort of traditional estimates, but those companies that have rallied, the companies that have reported, 60% of them have actually moved up on the day of reporting. Those companies that have missed and refrain from giving guidance, they've been taken to the woodshed by the market. The market's not treated that kindly at all. So they've seen businesses that are beating expectations. They're the companies you want to be leveraged to at the moment. Those companies are missing, not guiding. People are saying, we don't want them in the portfolio. Let's get rid of those. But there are companies that are doing well. And tech's leading at the moment. So I take the view personally that, the tariff news has got a bit further to go. We can probably get a bit of squeeze up there. A lot of the shorts have covered those positions right now. New cash has come in from the market, from risk parity funds, from vol targeting funds. And I think there's probably a little bit more to go in this situation. So I think probably, 200-day moving average is another level, just below 5,800. But we get up to that point there. We've got the positioning unwind. We've got through earnings. I know Nvidia's not till the end of the month, 28th of May. But we get that positioning squeezed up. We get to a level up to 5,800 where, I think then we can start focusing on the data. The next move from 5,800 will be driven by the data. We've got payrolls tomorrow, which we can talk about in a second. But, it's just the soft data has been so weak. The survey-based data has been so weak. Now we need to see the hard data, your payrolls, your GDPs, all those sort of bits and pieces come to the party. And that's the debate now. Are we going to get a muddle through, or are we going to see high recession risk? And that's not going to be answered right now. It's going to take a little bit of time to filter through. Are we going to see those shelves in America being empty as supply chains have the biggest hit since COVID effectively? And I think that 5,800 level will be the level then we can have that pause reassessment. If we do see the data really weakening off on the hard data side, those earnings at the moment in the US are too high. They're too high. The market's expecting 10% EPS growth for this year, 14, 15% for next year. If we're going to see a recession and we see higher evidence of that, those earnings are too high. They get cut up and we go much lower in the market. So that's where we are. But I think we get a squeeze higher. And I think that takes us really nicely into that payrolls number that I talked about, Blake. Because what I'm saying here with the data, right? I talked about that soft data. It's been disastrous. You've seen that in the Dallas Fed manufacturing numbers, or the Philadelphia numbers, Richmond Fed numbers. They've all been really, really poor. But the hard data's been okay. I mean, you talked about the GDP number last night was down 0.3%, but it was a bit of a red herring because it's all imports coming in, people front running the tariffs, and if you look at private sector demand, it was high, and consumption was okay. So, I don't think that GDP number was terrible, and the personal spending numbers were okay. Durable goods numbers were okay. The S&P Global PMI numbers were okay. So it's really about what happens in the May data series if we are going to see that roll over. That said, with this payrolls number now, with people saying that the jobs aren't going to really dissipate through until the next payrolls number on the 6th of June, if this one is weak, then it will accelerate that view that perhaps things are a little bit worse than expected. So I think people go into this with a consensus number of 135,000. I think the market will have a big reaction and get really quite concerned if we get below 80,000 or so. If the unemployment rate was to tick up to 4.3%, I think people then accelerate that view forward. And you're already seeing a situation where stocks are going higher, but rates are pricing in more and more rate cuts. Front-end yields are moving lower. And that's a disconnect which I think needs to reconcile. So I think this payrolls number tonight is really, really, really important. And I think the volatility around this number is very high as well.
So let me ask you this question then, Chris, and just for baseline, so everybody understands, the unemployment rate of 4.2% is what is expected.
Yeah.
So what Chris is saying is, if it ticks higher to 4.3%, that's going to be a concern. So is bad data bad for the markets?
Yes.
Or is bad data reinforce the idea that rate cuts are coming sooner rather than later?
Oh, I think it's a great question. No, I think the biggest risk to risk is a recession. And I think the market's got that on the radar. If it wasn't on the radar, then I think you'd see a situation where bad data would be good for the equity market, because you're going to see more rate cuts coming through. But rate cuts in a recessionary environment, which I'm not saying is going to happen at the moment, we could easily get a muddle through, and the data could come out better than expected. But in a market that does see recession risk growing, probably from you're going into June, into July, if we were to see clearer evidence of it now, rate cuts in a recession don't really do a huge amount. The Fed chases that situation, and earnings then get cut up. So I think, a bad payrolls number will be bad for equities and risk, and certainly the US dollar. Do you disagree with that?
No, I do agree with you. I agree. I actually agree with you. But some people still have it. It's the Pavlovian response.
Well, hang on. We saw proof of it last night. GDP number weak on surface, good below the surface. ADP numbers were poor. What happened to the equity market? It was down pretty hard at one stage. Everyone was saying because of the data, and it was only towards the back end of the session, people saying month-end flows, and also people getting ahead of earnings, that we saw it. So we saw evidence of that last night. In the session that's just been, that the equity market was down on bad data. So I think bad payrolls number, the equity market goes lower.
Good point. Oh, great. Well, the last thing I wanted to talk about is just because the next time we talk, it's going to be past the Fed meeting. So I do want to talk a little bit about the FOMC. And I can't tell you, Chris, how many comments, or actually I should say questions, that I get from traders. I get phone calls, I get texts. When's Powell going to cut? Are we going to get an emergency cut? So let me just say that absolutely not. And that's not happening. We'd have to be trading below 4,800 in order for us to even think about there being any type of emergency cut anywhere. Yeah. But really, you talk about next week. Next week, the Fed's not expected to do anything. I think their hands are a little bit tied here. You're seeing inflationary data that's already percolating. Whether you got the employment cost index today, some of the GDP prices numbers, they came in a little hot. Then you got an economy that looks like it's going to slow. I mean, and they don't know what the repercussions of the tariffs, as you pointed out. Maybe in the next couple of months, some of our shelves here in the United States, we might be a little empty on things. So we don't know what those supplies disruptions are going to look like. I don't think the Fed knows. So I think they're going to be very cautious. But at the same time, with all that being said, what type of direction do you think we're going to get? And what do you think the reaction is going to be to the Fed? Or do you think it's just going to be a non-event because everybody's expecting the Fed to be like hands tied? They're not doing anything.
I feel like it could be a non-event, but I feel, I haven't really gone over the probabilities and scenarios at this stage. I mean, I think obviously they're not going to cut rates. That's not going to happen now. But the fact is, for me, it's like, what's being priced into the following meeting in June. And there is there's 60-70% chance of a rate cut there. So that I think, you'd have to see the door being opened. Now, I think longer term inflation expectations have come down a bit, actually. And I think that would be a very big positive for the Fed to want to cut rates. But I think if we were to see again, it comes to the payrolls number. If we see a really weak payrolls number, the unemployment rate ticks up to 4.3%. We see below 100,000 going into 80,000 or below, going into the bottom end of that consensus range, then the Fed will have to open the door to a rate cut at the following meeting. I think they'd have that. Soft data's weak. Inflation expectations, longer term inflation expectations are well anchored, if not falling. The crude price is down. And I think you saw that in the payrolls number. That would be then the Fed opening the door to saying, giving us a bit of nuance that they're giving us guide that they're going to cut in the next rate. If the payrolls number is really strong, the unemployment rate stays 4.2, maybe even trickles down to 4.1%. I think they'll be quite ambiguous about the situation, and we won't get a huge amount of colour, and it will be down to further hard data that they'll basically say, things are hit and miss. We don't really know, and they'll bide themselves some time. I think they'll be pretty patient there. Would you disagree with that?
No, well, I do agree with you actually on your assessment there, because I do believe that the Fed, I don't even know if they would even open the door to a rate cut at this point in time, and I think that might actually disappoint the market a little bit. I think it's too fluid of a situation with what's happening with tariffs, obviously the economy and where we currently stand with all the data. Guidance that we're getting from companies. The Fed is very well aware of what's happening around the globe, and they understand that inflation expectations aren't quite anchored at this point in time, and they can't derail that. So they have to be really careful about letting rates slip any further based on not knowing. So I don't know. Like I said, they might be more, as you point out, more ambiguous in this next Fed meeting. And I think maybe the market will want more than that.
Purposely vague. Now, I think probably the most one of the funny things that will happen, and it's going to happen, you can bet your house on it, is when they leave rates on hold and they give potentially this ambiguous, is what happens on Truth Social. Trump will come out straight away. Powell doesn't know what he's doing. I know more than Powell. They should have cut rates, blah, 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 blah. So that will be the funny thing, is to see Trump's response and how punchy. We know he's going to keep his job now, Powell. That's obviously, much to Trump's dismay, disdain for that. I think he's going to keep his job, but it won't stop Trump coming out and giving him an absolute spray after he leaves rates on hold.
Nothing stops that man. Nothing stops that man. I'll tell you that much.
Yeah. Anyway, let's go to that's the setup. All right, I'm going to go to that US 500. I've talked a bit of length for this, and actually, to be fair, it's the Nasdaq that's outperforming there. But you can see a lot of green on screen to the right of the charts. It's making higher highs. You can see those big wicks to the downside, but hoovered up, buying support coming through. It is a bit of a grind, and what I like about this again is that you've got that short-term moving average, the 5-day exponential moving average, and for me, take your mind out of what's happening behind the scenes. Tariffs, are China talking? Are they not? Are we going to see a deal with India, UK? Whatever that looks like. Is a deal different from an agreement? It doesn't matter. What's the data doing? What are the rates market doing? Yeah, the fact is we are seeing the market grind up. Every pullback into that 5-day exponentials being supported and used as a buying opportunity, and it makes a new high. For me, that's a situation where you don't even think about what's going on in the macro. You just look at the price action, look at the supply and demand that's coming through, and this is grinding higher, which tells me that there's a higher probability that we do get that squeeze up over time into 5,800, 5,780, maybe a little bit higher than that. And then potentially I look to fade that move from those points. But again, it's what it looks like into that point. But for me, when markets are moving up or down and it's holding those moving averages, it's telling me that trend is strong at the moment until it closes back below those levels. Something pretty interesting is going on in the market. We need to be open-minded to where it can go. The market will go where it wants to go, as we know. And trying to fight this right now, I think, seems to be a lower probability outcome. So from a directional bias, pullbacks of buying opportunities, I think we can squeeze a little bit higher here.
What's interesting, Chris? Now, remember yesterday's candle, that big green wick, it was red at one point. And this is where the closes of the market, the closes of these candles actually matter.
Yeah,
like the market
absolutely.
looked really bearish early on in my session. I know you were sleeping. By the time at the end of the day, it reversed course and we closed higher. I had to close out my short risk positions as a result of that.
And I think we just got to be open-minded to the idea that how much of this is month end as well. They had a shocker of beginning of month and people were rebalancing. So maybe this is a bit of rebalancing. So, it's a new month for me today. So the session in ahead will be interesting. We know Microsoft's going to have an absolute ripper. It's 6% of the S&P. So that's obviously a big one. But let's not forget Apple. They're coming out with earnings in the aftermarket, and the market's expecting them to have a move of 4% up or down. That's what the options implied are doing. and Amazon as well. Now they got into themselves in some right beef with the president coming out and saying they're going to claim how much tariffs are influencing price, and they're going to have that on the situation. And Trump saw that as an act of aggression. But the stock is expected to move up or down 6% on the day of reporting. So both stocks expected to have some good vol coming through. So will the baton be passed? I think the bar for these guys to beat has probably increased a little bit, given what we've been seeing from some of the other discretionary and tech plays. And so it'll be interesting to see if they can beat a market in that situation. But the market is expecting big movement from those. And that will take us potentially a bit more of a squeeze there. So we'll see what happens.
All right. Well, I'm gonna take you over to my first setup, which is the Aussie yen, because tonight, hey, it's the BOJ. BOJ is expected to not cut rates. They're expected to keep rates unchanged. But a lot of traders are looking for a potential move here out of the yen. And I'll tell you, one of the best setups I have right now is the Aussie yen. You can see how it's capped by a 618 retracement. I actually highlighted that in green. That's previous support. It's current resistance. That's at 92.20, so 92.20. That is the 618 retracement. That is key resistance going into tonight's BOJ. Support is at 90, and I highlighted it in red. You can see below the red level, that support broken, you're going to resume the downward trend. If it breaks up, it's going to break through 92.10. It clears the 50 DMA, which is that orange, moving average. We'll probably see that descending trend line come into play right after that. Now, I had originally thought, Chris, that what was going to break the Aussie yen to the upside would have been a China-U.S. deal was agreed to in principle. I thought that would be the catalyst that drives us higher. I didn't think that it was a pop that we've seen in risk and maybe some positive earnings that can do it. But I do keep an open mind, as you talked about, that it could be the catalyst that drives the Aussie yen to continue to squeeze alongside risk or alongside stocks moving higher, especially if the S&P makes its way to Chris's target at 5,800. So keep your eye on the Aussie yen. BOJ is tonight, and I will be up for in our community, looking around, trying to trade around the news. Hopefully we get a big move, and that's the setup for this evening.
Yeah, I think you're a sucker for punishment, mate, to be honest. I don't think the BOJ is going to really be that much of a catalyst, to be honest. But, I bid you, I think, obviously, dedication to your subscriber base. Well done. I want to go to Bitcoin, because this was one of my play of the day last week. I like what I'm seeing. We had that 8-day consolidation, phase that we went through. Market broke out. We closed about halfway through the range, but then we saw a higher high and obviously saw an explosive move up into 95,000. The ETFs the flows into the ETFs have been pretty strong. They've died down a little bit now. And you can see that reverberated in the price action. So we've got these kind of series of inside days that have come through. The market's just not sure what to do with this going forward. And I think it needs to probably take the time frame down and trade the range, long, short within that. But be prepared, for me, to honour and respect the breakout. If we get a breakout, that top end of 95,200, obviously, people are going to be talking about 100,000. The order book is pretty stacked on the sell side towards that level, so they've would have chopped through that level, and it probably will need to see the Nasdaq continue to squeeze a little bit higher and just risk sentiment coming through. But I think this break, if we see a downside break, maybe the 200-day moving average comes back into play, and we can retrace some of those gains that we've made recently. But this is a really interesting one. You're either trading the range or you're waiting for the breakout. Which way does the breakout come? I suspect it will probably come to the upside. That's where these things usually rectify themselves. But this is on the radar at the moment. It's a setup that I think the longer this consolidation goes on for, the more powerful the potential move. And so I'm just got my alerts. And I think when that breaks, obviously that will potentially set up a new leg up higher in Bitcoin.
Chris, I know you talked about it last week, but that from an Elliott wave point of view, that'd be a very impulsive move, which you're right. The next move, follow-up move tends to be in that direction of that big, powerful, those big green bars. I always like to say big green bars are usually followed by more big green bars.
Yeah, right.
Strength begets strength. You get it. Yeah. Speaking of bars and big bars, take a look at crude. Crude is a setup. Now, I bring this up, Chris, for a couple of reasons. Crude has been acting like crap. There was a bunch of headlines about Saudi Arabia, their output. I mean, look, if I was the Middle East, I was trying to squeeze, I was trying to squeeze North American producers out of the market. I'd do it by just reducing production, and they're like, we have longevity, you probably don't. So with that being said, or increasing productivity rather than and get prices down. And so what we're seeing is a slide in crude. Now, I think a lot of people believe the 55 level is really critical. Now, that is the 127% extension of the May 2023 low to the September 2023 low, or the low of 2023. Now, if the 55 level is broken, I think that's where it gets a little slippery. And we could probably see sub $50 levels below that. I don't think that's going to happen, me personally. So the reason why I say this is a setup, because if you get to $55 or right around there, I think it provides a good level to trade off of. But because you know where you're wrong, because below $55, it does open up some downside. And then we're targeting probably, like I said, sub 50. I think you can trade this a couple different ways. I think it's worthy of being on your radar, because crude is, any which way you slice it, it is trading heavy right now, and it is moving.
Yeah, I think that's a good one. I think you get down to $55 again. You will see a response from the producers in the US, because that's when you're starting to get into break even. It starts to really impact their profitability. So I think Trump's done a good job. I think, he's obviously behind closed doors lent on OPEC to try and get more out. They're increasing production in May. They're going to be increasing production in June. He's not going to get that from the US producers. The irony is he campaigned on getting more out of production in the US, but the producers in the US don't want to do that, because it's not profitable for them to do that. You need a higher oil price and then they'll produce more, but that's not the case. So I think we get down to $50, you're going to see a response from the onshore producers in the US who are going to come out and say, this is not profitable. They may threaten to cut back on production, which may stabilise the WTI price. We'll see. And that may prove to be a level scalpers may look at. Anyway, let's go to play of the day. Right, I'm going to go for a bit of a cheeky tactical play. Long Nasdaq, short China. I mean, again, whilst we may see a trade agreement from China, or at least signs, I actually don't think we will see one. I think we'll see lots of good talk that something's going to happen. I think it's going to take a long time to create a deal. I think it's going to take a really, really long time to create an actual arrangement that could potentially see that. And again, with tariffs, it's really not about what we're hearing. It's about trying to model what the end effective tariff rate looks like, because that's where we can understand that the threat on economics in terms of growth and supply chains and various factors, and that's something we're trying to understand. But right now, the Nasdaq's got its mojo. You could, if you don't want to do the pairs trade, the long short strategy, I have to stay long, buy pullbacks in the Nasdaq, buy pullbacks in the US 500. But for me, as part of a sort of a tactical suite of a portfolio run, I think that China's going to underperform. And I think that the US continues to outperform in the short term. I think longer term, this trade of US exceptionalism, US repatriation into other places like long Europe, short Nasdaq will probably work. But really short term, this is working now. The Nasdaq, I think is I've actually got this chart the wrong way around, actually. So this actually is showing, if this going down, it's showing that the Nasdaq's outperforming the China. So I think in this situation with this pair, short China, long Nasdaq's working. You can see that in the chart now. I think this has got further downside to go.
All right. Even though you had to clarify that on the chart, that still makes sense to me, Chris.
Yeah.
And I like that chart.
Well, you can see in the top left the pair. So the CN50 is the denominator, is the numerator, sorry. And therefore, if it's going down, it's underperforming against the Nasdaq.
Very good. All right. Well, I'm going to bring something with a very similar look. It's actually a head and shoulder pattern on the euro dollar. And just so you know, it's a trap. And that's General Akbar from Star Wars, just so you guys know. Hey, look, I actually got a message from one of my good friends, an analyst,
Christine Lagarde?
No. Holy cow. Mark from Bannockburn, Mark Chandler, and their firm does B2B FX type of stuff, right? Not B2C, it's B2B between companies and corporations around the globe. But he's a great guy. I've read all of his books. He's been around for decades and decades, and he's one of the first people I've actually ever listen to as far as currencies go. And he was asking me about this head and shoulder pattern in not only the euro, but we're seeing it in a lot of different currencies. I see it just like you guys. I do believe the 112.70 is the neckline. And I believe if it breaks down, it's going to be in full head and shoulder, failed to break down completely and failed move. I'd be looking for a dip down to 111.60 to be on the long side, that 50% retracement, because that trend line goes all the way back to when the euro was 160. So going back from 160 to current price, that takes us to about 111.50. That's going to be the level that I'm going to be looking to be on the long side in the event the euro does come down. So be careful. It's a trap.
Well, that's right. I mean, the world's got so the positioning in the dollar is still very, very short. But the data, if the hard data holds up, and we need to be open-minded that it could be less bad than feared. Yeah, the dollar's got some upside, and that takes us down there. To then we get the next set of data. So, yeah, we could easily see a situation where the dollar strengthens in the short term. But in the short term, some of that position still gets flushed out. And I think for me, if you take a view that euro dollar's 116, 120, and then in by Q3, you probably want to see a situation where that big move we've been seeing does get a bit flush out, and that give you a much cleaner position to take another run higher. So just be open-minded to that dolly move. But I think the data will obviously be the driver of that situation. Anyway, Blake, thank you very much for your show today. There's obviously a lot going on in financial markets. We've got to be open-minded that all these big consensus positions are causing ripples. People are questioning them. We just be open-minded to what the market wants to do. Anyway, thanks for everyone. Smack the like button. Leave us your comments, and we'll try and get back to them as soon as we can. We really appreciate them, and we'll see you back next week for more of The Trade Off.